The top business stories live from the Sky newsroom. The Chancellor breathes a sigh of relief as markets stabilise following the budget. Gilt yields retreat, but is the worst over? We'll hear from a fixed income expert. And it's just days until Americans decide which presidential candidate is best for their bank balances. Very good afternoon and welcome to Business Live with me, Darren Mccaffrey. On this Friday, well, the UK bond markets have stabilised after rising significantly yesterday following the budget. The benchmark 10-year gilt yield has retreated since the market opened at 8 a.m. this morning and is holding steady. So let's bring in our economics and business correspondent, Paul Kelso, who's in the studio with me. Paul, just explain what has kind of happened the last 24, 48 hours and why things do seem to have stabilised this afternoon.
Number one, we've been watching the bond markets because we've got long enough memories to remember 2022, the mini-budget, when huge market movements caused a crisis in UK markets. So we were looking to see what happened after this budget on Wednesday. The answer was on Wednesday, not much. Yesterday, things changed. The bond markets, UK 10-year gilts, which is a measure, a proxy essentially for what it costs the UK government to borrow. The cost of that borrowing rose through yesterday, not massively, but significantly and unusually. And it seemed to be an indication of two things. One, the markets were surprised about how much Rachel Reeves wants to borrow. They knew some was coming, but some of this borrowing is going to be for day-to-day spending, at least initially. So that may have put a premium on the UK, and also perhaps the expectation that this budget will be inflationary, and that might slow the Bank of England down in cutting rates. Question this morning was, would that continue? Well, after a little flick up, it didn't. It receded, and the bond markets, the 10-year gilts price fell back below where it started. Yesterday, still following, yesterday we saw the spike, so it seemed to settle. It has gone up again this afternoon, but it's gone up since another bit of data, nothing to do with the UK, jobs figures in the US. US treasuries have gone up. And if you look at bond prices around the world, they've followed that price. So at this point, they have finished higher than they would have liked, but it looks like there's some more data in the mix. So listen, if you could read accurately the bond markets, we wouldn't be sitting here. We'd be making quite a lot of money.
Well, I'm now going to ask you for a prediction, because that's what we do, to be annoying on a Friday afternoon. I mean, are we now out of the woods? I know the Bank of England's meeting next week. What is the expectation about where this might go next?
Well, I think you mentioned the Bank of England, and that's probably the key next set of data. Rachel Reeves, I suspect, and the Treasury team will be more relaxed than they were yesterday afternoon. Remember, about this time yesterday, Rachel Reeves popped up on Bloomberg. Other specialist business outlets are available, but sounding like she wanted to reassure markets. We had her number 2 on the morning round this morning, so I think they were trying to talk things down and reassure markets. I think they'll be happier. On Thursday next week, the Bank of England does two things. It sets its interest rates. Still widely expected they will come down 0.25%. It also produces a new set of forecasts for inflation and for growth that will reflect the measures in the budget. These markets and everyone else will be looking very closely. Is the bank going cold on extra cuts to, or on the rate of interest rate reductions? And that's the issue that, along with other things, in my limited expertise, would suggest will set the next trend here. But I think the Treasury will sleep a bit easier going into the weekend.
Okay. Well, you can come back on Monday and we can talk again. Paul Kelso, thank you very much indeed for joining us. Now, following a turbulent reaction in the bond market yesterday, gilt yields have steadily fallen today. But as I say, it's a bit of a mixed picture as investors continue to suggest the Chancellor's £28 billion worth of increase. Well, joining me to explain the nuts and bolts of what's happened in the markets over the last 48 hours is Oliver Faisala. He's the head of fixed income research at Charles Stanley. Oliver, very good afternoon to you. Hopefully you were listening to what Paul had to say there. There is a sense that, you know, if there was panic yesterday, it has calmed down a little, but still some concern.
Yeah, I would completely agree with what was said before. There was an initial panic, and I think quite rightfully so. There was a major fiscal easing, an increase in borrowing, and an increase in forecast inflation. So, you know, the market did sell off quite a bit. At the moment, there are a number of global economic and political risks that are making markets quite jittery, perhaps more so than usual. As a result, we saw that sell-off. Today, things are fortunately a little bit more calm.
But in saying that, the budget has caused concern. To be wrong to suggest otherwise, wouldn't it?
Absolutely, it was a surprise on the budget. There was more borrowing than expected, and a lot more spending, and as a result, as I mentioned, an increase in expected inflation. So markets have quite rightfully repriced, Bank of England cuts going forward, and treasuries have, UK treasuries, UK gilts have sold off. We didn't see the same magnitude that we saw, during the Truss Kwarteng mini budget in 2022. A little bit more subdued, but nonetheless, there was a little bit of panic, and I think most of that has now come through in prices.
Let's look at kind of the longer macro picture in the sense that where do we think this budget, what is it going to lead to? I mean, according to the OBR, we are looking at a lot of increased borrowing, but also pretty tepid growth for the next 5 years.
Yeah, I think that's quite disappointing. Compared to perhaps what the chancellor would have wanted. The view on growth is a little bit subdued. I don't think that's had a huge influence on the bond market. I think the bond market, especially the gilt market, moved more so on the fact that there was more supply of gilts, more issuance of gilts. That issuance is skewed a little bit more to the long end, and that inflation is likely to tick up as well. The fact that growth is unlikely to be as buoyant as the government may hope, it's an additional detractor. Obviously, debt to GDP probably isn't going to fall as much as they would like.
And just very finally, Oliver, I suppose the one kind of element we haven't talked about that's in the room, clearly when it comes to, and this is a country that's not been struggling with economic growth, is the United States and that massive decision next week with the US election. What impact could that have? And what are the markets? Are the markets now factoring in a Trump victory? Is that where they're at, you reckon?
I think US Treasury prices do have some of that priced in. Now, if we got a Trump victory and a full sweep of the House, a full Republican sweep of the House, then I think we could probably see a little bit more of a sell-off in US Treasuries for sure. Now, that's definitely the biggest, global economic risk at the moment. It will have a feed through into gilts and other, government bonds worldwide. The markets are concerned about a Trump presidency. If that does come into fruition, and we do see that, especially if we have that full sweep of the House, then yeah, absolutely, there could be, more of a sell-off, because essentially what we'll have is more uncertainty. We'll have, more sort of expansionary fiscal policy, larger issuance of US Treasuries. So that's absolutely going to impact the US Treasury market.
Okay, Oliver, really, really fascinating stuff. Thank you so much for your time. That's Oliver there from Charles Stanley. Well, let's bring in someone else who has been on the, I think that's fair to say, the coalface of fiscal policy during this time. That's Gerard Lyons, who's the Chief Economic Strategist at NatWealth. Of course, was a former economic advisor to the former Prime Minister Boris Johnson when he was Mayor of London as well. Gerard, thank you very much indeed for joining us. First of all, let's step back a little bit. There's been a lot of opinion on the budget in the last couple of days and the impact it might have on certain sectors, the impact it's had on the markets. But ultimately, wasn't this just a Labour government delivering effectively a very Labour budget, having just won a stonky majority? None of this should be in some ways surprising.
Yeah, well, the Chancellor very much focused on the need to boost growth, which is the right thing to do. And the big positive out of the budget was the fact that she was focusing on trying to boost investment, focus that has to be said on public sector leading the investment drive. But coming back to your question, you're right, and this is picked up in terms of the markets. It was very much a tax, spend and borrow budget. The budget itself is adding about £69 billion per year to spending over each year of the rest of this decade. And given that growth is not particularly strong, that has to be funded somehow. And it's being funded by about £36 billion per year of tax and £32 to £33 billion a year of additional borrowing. So the Chancellor is hoping that there will be a boost to growth, and the independent forecaster, the OBR, and I think they're right in this, thinks there will be a sort of sugar rush of growth in the next 2 years, and then the pace of growth tails off. So the backdrop is one where the Chancellor, in economic terms, is focusing on growth and public sector investment. She obviously has a political agenda as well, but the concern is whether that growth can be sustained. And from the market's perspective, as you just touched on, is about the borrowing outlook. And also over the next week, what does it mean for interest rates with the Bank of England meeting next week?
In saying that, Gerard, I mean, as I said, there's a range of views. I'm just reading here what Barclays chief executive has said, saying that she thinks Rachel Reeves has done an admirable job of balancing spending, borrowing and taxation. Is that an assessment that you would agree with?
No, not really. What is said is technically correct. But the real issue is this, that the government has inherited a moderately improving economy, but the UK growth outlook is still pretty poor. Has to be said, it's true of Western Europe generally. But the big issue is that whoever won this election, it would be hoped would address the fact that the government has inherited a very poor fiscal position. Debt levels are very high. And what we have after this budget, and again, this is reflected in how the market's reacting, is a backdrop where the growth picture is far from strong or reliable. The growth picture might start to tail off in a couple of years, but the fiscal numbers, those debt numbers, still remain very high. Basically, we have levels of debt just below 100% of GDP on the old measure, but still high on the very new measure. So the concern is if there's upward pressure on government spending next year with the comprehensive spending review, or if there's going to be a dismal performance and growth relative to expectations. Either of those scenarios would add to pressure in terms of public finances. So we have a backdrop still where the economic outlook is fragile, far from great, and the fiscal numbers are not particularly good. Next week, of course, the Bank of England, interest rates do need to fall to help the outlook. But as a result of this budget, because of the near-term bounce to growth, because this budget might lead inflation to be higher than previously expected, and because of the higher level of borrowing, even though interest rates will still fall, the perception is they might not fall as far as we previously expected or hoped they would.
And Joe, what would you say, though, to those that have looked at the previous 14 years with the Conservative government and they've looked to effectively a period of time where we saw very little or anemic growth, and that, you know, Rachel Reeves, yes, she's borrowing more money. She's definitely going to invest more money. She's also raising taxes. But in the end, that might achieve something different from what hadn't been achieved effectively over the last 14 years.
Yeah, well, it's a very valid question. On the positive, the budget is focusing on trying to boost investment. That should be welcome. But the benefits of that take time to feed through, and the borrowing, because of that, feeds through immediately. The negative of the budget is the high taxes this imposes, particularly on small and medium-sized firms, and the higher taxes rarely help the growth outlook. But coming back to your question, it's the key issue, and in some respects it's away from the politics, is that since the 2008 global financial crisis, the UK has become a very slow growth economy. It is true of Western Europe more generally, but we haven't really recovered or taken stock of how the economic outlook has changed in the wake of 2008. And that's been the real economic turning point in the last 15, 20 years.
OK, Gerard Lyons, as always, really appreciate your time. Thank you for joining us there live from Sevenoaks. And don't forget, you can get more on the budget and indeed the rest of the money news on our Money blog. All you need to do is scan the QR code that's on your screen right now and keep up to date with the latest financial and money news. Now, we're going to stick with the budget because Rachel Reeves has extended business rate relief for the UK's hospitality sector. However, industry figures have criticised a 25% cut in the relief, as well as the increase in employers' national insurance contributions and indeed an increase in the minimum wage. Well, earlier I spoke to Marcus Teslev, who owns 6 different venues in London, about how he thinks the budget has gone down in the hospitality industry.
Most of my peers I'm speaking to can't absorb any more costs, and There was a study out this morning by UK Hospitality saying that roughly they expect that each full-time employee is going to, in hospitality and retail, is going to cost another £2,500. So someone like ourselves, who've got 470 odd members of staff, and plus we offer a bunch of benefits like private medical insurance and a lot of charity work that we do. You know, we're going to have another £500,000 onto our wage bill a year, which is not a joke.
Now to American data show that the US has added far fewer jobs than expected in October. The US non-farm payrolls report showed that the economy added just 12,000 jobs in October compared to a Dow Jones estimate of 100,000. This is unsurprisingly rejuvenated hopes for a Federal Reserve jumbo cut in interest rates. The unemployment rate, however, held at 4.1% and is overall in line with expectations. And speaking of America, there are just, of course, a few days left before Americans go to the polls in what is one of the closest elections in recent decades. However, despite booming growth and near-record employment, many have blamed the Biden presidency for inflation. Well, earlier I spoke to a former Clinton aide, Maurice Reed, about what he thought was the main issues motivating voters ahead of next week's election.
Most people really focus on their pocketbook issues, their purse issues. So understanding inflations, it really doesn't matter. When you're a family of four, you're a single mother, what you care about is, can you make ends meet? Do you have enough at the end of the month to pay your bills and to make sure your kids are safe? That's really what voters care about. They don't really care about what's happening from a international perspective. As Tip O'Neill said, all politics are local. So what the president of the United States or a candidate for president of the United States has to always communicate those local issues to the voters first and foremost. And the economy always will be number one.
There you go. You're watching Business Live on Sky News. We're going to take a quick break. Coming up next, though, we're going to be looking at those markets, how they've fared this afternoon. The FTSE up a little on this Friday afternoon. We'll have all the details in just a couple of minutes.
Weeknights on Sky News.
This is your chance. Tell people. Welcome to the Politics Hub.
Our police force has apologised. If you want to find out about Grimsby, you come to the docks.
I'm live in Jerusalem. Are you not concerned that that could lead to all-out war?
Hello there, good evening. There are fears of an upsurge in violence. What's at stake here?
You are watching the press preview, a first look at the front pages as they arrive.
I'm Adam Parsons, Sky's Europe correspondent based here in Brussels. I've witnessed migration across Europe close up.
I'm James Matthews and I'm Sky's US correspondent based here in Washington, D.C. Mr. Musk, has your ignorance and ego cost Ukrainian lives? Free, wherever you get your news.
I'm Ivor Bennett, Sky's Moscow correspondent.
Why do you support Vladimir Putin, Mr. Segal?
I'm Conor Gillis, Sky's Scotland correspondent. Sky News, the full story first.
I say, bring it on.
With America divided and tensions running high, get ready for an election like no other.
Join our teams as we follow the campaign trail as America decides.
We will win, win, win. Get closer to the action this US election with full reaction and analysis.
Sky News, the full story first.
Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers.
We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
I say, bring it on.
With America divided and tensions running high, get ready for an election like no other.
Join our teams as we follow the campaign trail as America decides.
We will win, win, win. Get closer to the action this US election with full reaction and analysis.
Sky News, the full story first.
There's always more to the news than a headline. We want to discover, to delve a little deeper To find out what's really going on, explanation, analysis, the people at the heart of every story. I'm Neil Patterson, and this is the Sky News Daily Podcast. So, by the end, we'll hopefully all understand what's going on in the world just that little better. Available wherever you get your podcasts.
We've got your Sunday mornings covered. From the front page and the sounds of the streets to the voices of the people who make the major calls and big picture politics beyond Westminster. We'll put you at the heart of our story. A new start to Sunday.
I'm ready. Are you?
Join me, Trevor Phillips, Sunday mornings on Sky News.
Let's take you through the markets. We're going to start in Europe, and they've closed higher this afternoon as traders considered the all-important US job report that we were talking about a little earlier. Almost all sectors are major kind of companies that have ended in positive territory, or at least on the indices, you'd say. Bank stocks led the gains up 1.5%. It comes shortly after European stocks closed lower last night with the steepest losses for a year as they looked at some corporate results, inflation data and our own budgets. Here in London, the FTSE is up, as you can see, 0.83%. We've had actually companies like Ricketts and Schroders leading the way, with the wealth manager buying back 120,000 of its ordinary shares, up 4.3% today. So a good end to the week for them. In the US, the benchmark S&P 500 index has been trading up at nearly 1% as traders get excited about a possible second jumbo cut from the Federal Reserve that we were talking about earlier. And as we've been reflecting today on the currencies, the pound has gained back a couple of losses that we saw over the last couple of days in response to the budget, up against both the dollar and the euro. Though the euro's down just a fraction against the dollar at 109. And let's finally end on oil. Brent crude is up just a little at $73 a barrel. Well, joining me now is James Athy. He's the fund manager at Marlborough and joins me this afternoon. James, good afternoon to you. We've heard a range of views on this programme about the budget. Let's just get your sense. I mean, there was definitely jitters yesterday, but as we head into the weekend, things do seem to have calmed down quite a bit.
Yeah, Darren, I mean, as your previous guests have said, to a certain degree, that there shouldn't have been too much in the budget that was a big surprise. It's a Labour government, and we expected them to increase tax and ultimately to increase spending. That's exactly what they've done. I think the gilt market was a little surprised at the amount of extra issuance that they're going to have to take down, and that certainly did help the weakness in gilt prices and the rise in gilt yields. Actually, I think the dominant factor, though, really is the inflation outlook. The fact that the OBR has bumped up inflation for the next few years fairly significantly in their forecasts just means that the market has had to consider fewer rate cuts from the Bank of England. And that's why we saw actually shorter dated gilt yields rising by more than longer dated gilt yields yesterday, because those short dated yields are much more sensitive to monetary policy.
Now, let's turn to the future and turn to what every single person in all of the markets globally are going to be looking at next week, and that is the US election. It's going to be a big moment for the global economy because both candidates have got very different prospects for the world's largest economy.
Yeah, I mean, the makeup of their policies obviously is very different in some ways. In some ways, it's less different. I mean, neither candidate has exactly campaigned on the idea of fiscal responsibility. You know, this is something which has been ongoing in the US for 40 or 50 years, where Republicans want to cut taxes and Democrats want to increase spending. And ultimately, that's just meant more and more deficits, more and more borrowing, and that's really a trend which has accelerated in recent years. And regardless of who wins, regardless of who's in the White House come January, markets are very much expecting that will continue. So from a bond market perspective, that's quite a nervy situation to be in.
And James, it's such a contrast. I've been reading this afternoon about the troubles in Germany, the sick man of Europe, as it's now been branded. But, when you look at Western Europe across the boards, growth is pretty anemic, if there at all, including here in the UK, and that is in such contrast to the United States.
Yeah, Gerard, I think, made a really good point that there's clearly been a break since the financial crisis. And actually, if you look in the UK, and something which not many folks are talking about, which I think is significant, is that obviously the financial sector in the UK was a huge part of the growth of the economy leading up to the crisis. But obviously, as we found out in 2008, much of that was highly speculative, highly levered and highly unsustainable. And so much of the anemic growth that we've had since the crisis relates to the fact that the financial sector is on more stable footing, but unfortunately that contributes less to growth. And of course, sorry, go on, Darren.
No, I was just going to say, just very finally and quickly, if you can, in saying that, the tech industry has driven a lot of that growth in the United States, but they've not necessarily had the best of weeks.
No, there's a very high bar now for investors. Obviously, valuations are very rich indeed, and we've seen results coming out this week, which in some cases have just given investors a little pause for thought as to whether indeed those valuations can be justified, and hence we've seen a bit of weakness.
OK, James, as I say, we're all going to be focused on that US election, which is coming up on Tuesday. The markets will definitely be looking at who wins on that. Thank you very much indeed for your time this afternoon. And that is it from me on Business Live for today. Of course, we're back on Monday at 11:30. Do join me then if you can. Up next, it is Jane Secker, who is in Spain as that death toll continues to rise, given the flash flooding that we saw in the Valencia region. She'll be live on the News Hour in just a couple of minutes. Do stay tuned for that. From me, for now, though, thank you for watching and have a nice weekend.